The quiet hum of a modern economy is a sound we rarely stop to analyze. Yet it is entirely dependent on a fluid, invisible pulse: energy. Imagine a world where the flip of a switch no longer guarantees light, or where the price of a gallon of fuel dictates whether a family can afford both heat and groceries. This isn't a dystopian fiction, it is the fundamental reality of energy blackmail. In the high-stakes arena of global geoeconomics, oil and gas are not just commodities traded on the NYMEX or ICE. They are sophisticated weapons of statecraft. When a nation controls the flow of hydrocarbons, it holds a metaphorical kill switch over the industrial output and social stability of its neighbors. We often view economic power through the lens of Silicon Valley innovation or Wall Street liquidity. But the bedrock of sovereignty remains anchored in the dark, viscous reality of crude oil and the pressurized flow of natural gas. As we begin this investigation, we must look past the ticker symbols to see the raw leverage being exercised in the shadows of the global market. The architecture of the 21st century is built on a fragile energy grid, and for those who control the valves, the temptation to use that control for political gain is becoming irresistible. This is the story of how the most essential resources on Earth became the ultimate tools of international coercion, reshaping the fate of nations and the security of every individual. The first tremors of energy blackmail are rarely felt at the gas pump. They begin in the sterile environment of high-frequency trading floors and central bank ledgers. Long before a pipeline is closed, the market begins to price in geopolitical risk through a spike in Brent and WTI crude futures. This volatility triggers a domino effect across global financial indicators. For a nation under pressure, the first sign of distress is often found in credit default swaps, CDS. These instruments, which act as insurance against a sovereign default, begin to climb as investors lose confidence in the country's ability to pay for increasingly expensive energy imports. As energy prices rise, the trade balance tips into a deficit, putting downward pressure on the domestic currency. For a developing economy, this creates a vicious cycle. A weakening exchange rate makes it even more expensive to purchase oil priced in US dollars, leading to a rapid depletion of foreign exchange reserves. This is the energy trap, a calculated tightening of the economic noose, where the target nation's liquidity evaporates, leaving them with a choice between economic collapse or political concession. When we look at the data, the correlation between energy supply shocks and the sudden evaporation of market liquidity is undeniable. It is a slow-motion car crash that begins with a diplomatic rift and ends with the freezing of national credit lines, proving that in the modern era, energy security is the ultimate prerequisite for financial solvency. To understand how this leverage translates into power, one must look at the mechanics of economic shockwaves. When energy costs surge, the impact is not linear. It is exponential. It starts with the Producer Price Index, PPI, as manufacturing and logistics companies face soaring overheads. These costs are inevitably passed down to the consumer, driving up the Consumer Price Index, CPI, and forcing central banks into a corner. To combat this supply-side inflation, institutions like the Federal Reserve are often compelled to raise interest rates, a move that cools the economy but also increases the cost of servicing debt. For a nation already struggling with energy blackmail, high interest rates act as a secondary shock, depressing real estate values and tightening the grip on household disposable income. This creates a scissors effect, where the cost of living rises just as the availability of cheap credit disappears. The psychological impact on the public is profound. As the purchasing power of their wages erodes, social cohesion begins to fray. In this environment, the energy provider doesn't just control the fuel, they control the very temperature of the domestic political climate. By manipulating the flow of resources, an adversary can induce a state of permanent economic anxiety, making the target population more susceptible to internal unrest. and more likely to demand that their leaders capitulate to the blackmailers' demands in exchange for a return to normalcy. Historical precedents serve as a grim roadmap for how these crises unfold. Consider the 1997 Asian financial crisis, specifically the case of South Korea. While often remembered as a currency contagion, it was fundamentally a crisis of liquidity and external shocks. When foreign exchange reserves began to vanish, the cost of importing essential fuel for an export-driven industrial machine became an existential threat. The IMF's intervention required structural adjustments so painful they were dubbed the National Humiliation Day. Similarly, look at Turkey in recent years. A nation bridge-linked between East and West, its economy has been repeatedly battered by its reliance on imported energy. As the lira plummeted, the cost of energy-denominated debt ballooned, pushing inflation to levels that decimated the middle class. These case studies reveal a recurring pattern. Energy vulnerability is the Achilles heel of modern development. Whether it is the hyperinflation of Venezuela, where the world's largest oil reserves couldn't save a collapsing infrastructure, or Argentina's recurring debt defaults fueled by energy subsidies, the lesson is clear. If a nation cannot secure its energy inputs at a stable price, its monetary policy, its currency stability, and its social contract are all built on shifting sand. These examples are not outliers. They are warnings to the developed world that even the most robust financial systems have a breaking point when the lights start to flicker and the tankers stop arriving at the terminal. The situation in Venezuela offers perhaps the most paradoxical study of energy leverage. A nation drowning in oil, yet paralyzed by a lack of usable energy. Here, the resource curse met systemic mismanagement, turning what should have been a geopolitical superpower into a cautionary tale of hyperinflation and infrastructure decay. When the state oil company, PDVSA, was stripped of its technical expertise and capital for political purposes, production plummeted. The resulting economic vacuum saw the bolivar lose its value so rapidly that it became cheaper to use banknotes as napkins than to buy them. This collapse illustrates a critical point. Energy blackmail isn't always an external force. It can be an internal failure to secure the very resources you own. As liquidity evaporated, the government turned to massive money printing, driving inflation into the millions of percent. Real estate values crashed in real terms, and the middle class was liquidated overnight. The Venezuelan case demonstrates that without a stable energy-to-currency peg, the social fabric dissolves. We see similar patterns in Argentina, where energy subsidies designed to protect the poor eventually became an unsustainable fiscal burden, leading to massive deficits and recurring defaults on international debt. These South American examples serve as a laboratory for understanding how energy, or the lack thereof, can dismantle a G20-level economy in less than a generation, leaving a trail of lost savings and mass migration in its wake. Moving across the Atlantic, the Greek debt crisis of the 2010s provides another layer of complexity to the energy-economic nexus. While the headlines focused on fiscal profligacy and the Troika, a significant underlying weight was Greece's massive energy import bill. Without its own sovereign currency to devalue, Greece was trapped in a deflationary spiral. High energy costs acted as a regressive tax, choking off any hope of an industrial recovery, while the nation's debt-to-GDP ratio soared toward 180%. This highlights a terrifying reality for many nations. When you lack energy independence and share a currency with stronger neighbors, you lose the primary tools of economic defense. You cannot print money to cover energy costs without violating treaty terms, and you cannot lower rates to stimulate growth because the central bank is focused on the union's aggregate inflation. Greece became a ward of the state, forced to sell off strategic energy infrastructure, ports, and power grids to foreign entities just to maintain liquidity. This asset stripping is the final stage of energy-driven economic subjugation. It turns a sovereign nation into a tenant on its own land. Similar pressures are now mounting in Turkey, where the central bank's unconventional monetary policy has collided with a surging energy import bill, leading to a dramatic collapse of the lira and a surge in the cost of living. In these scenarios, the energy provider doesn't even need to cut the supply. They simply need to wait for the market to realize the target can no longer afford the price. In the United States, the vulnerability to energy blackmail is often masked by the nation's status as a top producer. Yet the American economy remains deeply sensitive to global price fluctuations. The shale revolution provided a temporary shield, but the integration of U.S. markets into the global energy grid means that American consumers are still hostages to overseas disruptions. When a geopolitical rival restricts supply elsewhere, the global price of crude climbs, and the American driver feels it instantly at the pump. This is the transmission mechanism of energy-led inflation. As the cost of gasoline and diesel rises, the logistics industry, the arteries of U.S. commerce, faces an immediate margin squeeze. This ripples through the retail sector, from the price of a gallon of milk to the cost of home construction materials. Furthermore, the U.S. dollar's historical link to oil, the petrodollar system, creates a unique risk. If major exporters begin to bypass the dollar in favor of other currencies for energy trades, the global demand for the greenback could soften, leading to higher borrowing costs for the U.S. Treasury. This would fundamentally alter the American lifestyle, as the era of cheap debt would come to a crashing halt. The U.S. is not an island. It is a node in a highly interconnected web, where a disruption in a Siberian pipeline or a Middle Eastern strait can devalue the savings of a family in the Midwest in a matter of weeks. The mechanics of this vulnerability are best observed through the lens of interest rates and the yield curve. When energy-driven inflation spikes, the Federal Reserve is forced into a hawkish stance, raising the federal funds rate to dampen demand. This is a blunt instrument that carries significant collateral damage. As rates climb, the cost of mortgage debt follows, leading to a cooling of the real estate market, a sector that represents a massive portion of American household wealth. We see a direct correlation. Every time energy blackmail pushes oil prices significantly higher, the likelihood of an inverted yield curve increases, signaling a looming recession. For the average citizen, this isn't just a chart on a screen. It is the difference between a thriving small business and a bankruptcy filing. Furthermore, the volatility in energy markets creates an environment of liquidity dry-ups. Banks and lenders become risk-averse, tightening credit standards exactly when businesses need capital to pivot or adapt to higher operating costs. This is how energy blackmail effectively exports economic instability into the heart of the American financial system. It forces a trade-off between price stability and economic growth. By weaponizing the cost of the very fuel that powers the U.S. economy, adversaries can force the world's largest consumer market into a state of stagflation. Stagnant growth coupled with high inflation, which is the most difficult economic puzzle for any government to solve. The government's arsenal against energy blackmail is often more limited than the public realizes. The most visible tool is the Strategic Petroleum Reserve, SPR, a massive network of underground salt caverns designed to provide a liquidity buffer during supply disruptions. However, the SPR is a finite resource. It is a tactical bridge, not a long-term solution. When a state actor engages in prolonged energy coercion, draining these reserves can leave a nation even more vulnerable to a second-wave shock. Beyond physical stockpiles, the government employs diplomatic finance, leveraging the Export-Import Bank and international development loans to help allies diversify their energy sources. But these projects take years, if not decades, to bear fruit. In the short term, the Treasury Department may use sanctions as a counterlever, attempting to cut off the blackmailer's access to the global financial system. Yet, this is a double-edged sword. Sanctioning a major energy producer often causes global prices to rise further, effectively punishing the very domestic consumers the government is trying to protect. This creates a geopolitical stalemate. The war room of a modern economy isn't just filled with generals. It is filled with energy analysts and currency traders who understand that every move on the global stage has an immediate, measurable cost to the national deficit and the strength of the sovereign bond market. Central banks face an even more agonizing dilemma when energy blackmail triggers a supply-side shock. Unlike a typical demand-driven expansion, where the economy is overheating, an energy spike is a cost-push event. If the Federal Reserve raises interest rates too aggressively to kill the inflation caused by high oil prices, it risks crushing industrial productivity and sending the unemployment rate soaring. Conversely, if it stays dovish to support growth, inflation can become unanchored, destroying the value of the currency. This is the definition of a policy trap. We saw this play out during the 1970s oil embargoes, where the U.S. suffered through a decade of low growth and high prices. Today, the stakes are higher due to the sheer volume of global debt. A sudden rise in rates to combat energy-driven inflation can trigger a margin call on entire nations. As the cost of borrowing rises, countries with high debt-to-GDP ratios, like Italy or Japan, find their fiscal space evaporating. The central bank must then choose between inflation targeting and financial stability. In this high-stakes game, the energy blackmailer isn't just targeting the consumer's wallet. They are targeting the credibility of the world's most powerful financial institutions, betting that the political pain of a deep recession will eventually force a retreat from the geopolitical front lines. The ripple effects of energy blackmail extend deep into the plumbing of global finance, specifically affecting the interbank lending markets and the concept of sovereign risk. When energy prices are manipulated, the basis swap markets, where banks trade different currencies with one another, often show signs of extreme stress. If a country is heavily reliant on energy imports, other international banks become reluctant to lend to its domestic institutions, fearing that the rising cost of fuel will lead to a wave of corporate bankruptcies. We saw this during the 2022 energy crunch in Europe, where the cost of hedging against currency fluctuations skyrocketed overnight. This is the hidden side of energy warfare. It isn't just about the physical gas in the pipe. It is about the liquidity premium that every business must pay to operate in an unstable environment. For a medium-sized manufacturer, an energy shock doesn't just double their electricity bill. It might cause their bank to revoke their line of credit because the bank's own value at risk, VAR, models are flashing red. This tightening of the credit markets acts as a force multiplier for the initial energy price hike, creating a localized credit crunch that can paralyze an entire industrial sector before the government even has time to formulate a response. Beyond the boardroom and the trading floor, the most devastating theater of energy blackmail is the kitchen table. For the individual, energy is an inelastic good, meaning you cannot simply stop consuming it when the price rises. You must heat your home, and you must commute to work. When a geopolitical adversary squeezes the supply of gas or oil, they are effectively levying an undeclared tax on every household. This tax is regressive, hitting the lowest income families the hardest, as energy costs consume a larger percentage of their take-home pay. We see this impact reflected in real disposable personal income data. As energy prices climb, discretionary spending on electronics, dining, and travel collapses. This shift in consumer behavior can trigger a retail recession. Furthermore, the psychological toll of energy insecurity creates a scarcity mindset. When people fear that basic utilities will become unaffordable, or worse, unavailable, they stop investing in the future. They delay purchasing homes, they put off starting businesses, and they hunker down in a defensive financial posture. This collective retreat by the consumer is exactly what the blackmailer intends: to demoralize the population and turn public opinion against the government's foreign policy. The individual's struggle to balance a checkbook becomes a tactical victory for the state that controls the valve, proving that the most effective way to destabilize a democracy is to make the cost of its daily life unsustainable. The real estate sector, often considered the bedrock of middle-class wealth, is particularly sensitive to the tremors of energy blackmail. In a modern economy, a home is more than just a shelter. It is an energy-consuming asset. When natural gas prices double due to geopolitical maneuvering, the carrying cost of a property rises significantly. For commercial real estate, this can be catastrophic. Office towers and shopping malls operate on thin margins, and a sudden surge in utility expenses can flip a building from a profitable asset to a non-performing loan almost overnight. We see this reflected in the valuation of real estate investment trusts, REITs, which often dive in tandem with rising energy futures. Furthermore, as central banks raise interest rates to curb the resulting inflation, mortgage rates climb, locking potential buyers out of the market and trapping sellers in homes they can no longer afford to heat. This stagnation in the housing market halts the wealth effect, the tendency for people to spend more when their home value increases. Instead, a reverse wealth effect takes hold. As equity evaporates and utility bills mount, the domestic economy loses one of its primary engines of growth. The energy blackmailer knows that by attacking the power grid, they are effectively attacking the equity in every citizen's driveway and the stability of the entire banking system's collateral. To survive this environment, individuals and businesses are forced to adopt what economists call energy hedging strategies. In the corporate world, this involves complex financial derivatives, swaps and options, to lock in fuel prices years in advance. But for the average citizen, the options are more visceral. We see a surge in demand for off-grid technologies, solar panels, residential battery walls, and high-efficiency heat pumps. This isn't just an environmental trend. It is a defensive financial maneuver to decouple one's personal balance sheet from the whims of a foreign dictator. However, this transition requires significant upfront capital, liquidity that many households lack, especially during an inflationary crunch. This creates a green divide, where the wealthy can buy their way out of energy blackmail, while the poor remain tethered to the volatile grid. On a broader scale, we see the rise of energy-aware migration, where businesses relocate from regions with high-cost, vulnerable energy imports to areas with domestic shale production or stable nuclear baseloads. This internal migration of capital and labor reshapes the economic geography of the United States, favoring states that prioritize energy independence. The individual's survival strategy becomes a micro-reflection of the national security priority, to build a moat around one's lifestyle that a pipeline shutdown cannot cross. The ultimate objective of energy blackmail is to force a regime of concessions, where the target nation's foreign policy is effectively outsourced to its energy provider. This is achieved through the systematic exploitation of the trade-to-GDP ratio. For countries like Germany or Japan, which are industrial powerhouses but resource-poor, the reliance on imported energy creates a permanent strategic deficit. When an adversary restricts supply, they aren't just raising prices, they are imposing a sovereignty tax. We can observe this in the way diplomatic rhetoric shifts during energy crunches. Leaders who once spoke of human rights and international law suddenly find themselves negotiating pragmatic energy deals with the very autocrats they previously condemned. This is the erosion of moral agency in international relations, driven by the cold calculus of the BTU, British Thermal Unit. The blackmailer leverages the just-in-time nature of modern energy logistics, knowing that a delay of even 48 hours in a shipment of liquefied natural gas, LNG, can cause a spike in the electricity spot market that wipes out the quarterly profits of a nation's entire manufacturing sector. In this sense, the pipeline is no longer just a piece of infrastructure. It is a leash. The strength of that leash is measured by the target's inability to pivot to alternative sources, making the time to transition the most critical variable in the survival of a modern industrial state. The concept of the petrodollar serves as the ultimate financial fortress for American interests, but it is also the primary target for those practicing energy blackmail. Since the 1970s, the global agreement to price oil exclusively in U.S. dollars has forced every nation to maintain massive dollar reserves, effectively subsidizing American debt. When an energy exporter threatens to accept euro, yuan, or gold instead, they are not just changing a currency, they are attacking the U.S. Treasury's ability to finance its deficit. This is a macroeconomic nuclear option. If the link between energy and the dollar weakens, the exorbitant privilege of the United States, the ability to print the world's reserve currency without immediate hyperinflation, could vanish. We see this tension in the fluctuating exchange rates of the commodity currencies, like the Canadian dollar or the Norwegian krone. When energy prices are weaponized, these currencies often decouple from traditional trade logic, becoming proxies for geopolitical power. For the U.S., maintaining the petrodollar is not just about trade. It is about ensuring that the world's demand for liquidity remains anchored in Washington. The moment an adversary successfully breaks this cycle, the cost of every American government program, from Social Security to defense, faces an immediate and permanent upward revaluation, as the global market no longer feels compelled to hold the greenback. The structural impact of energy blackmail often manifests in the deindustrialization of developed economies. When natural gas serves as both a power source and a raw feedstock for chemical, fertilizer, and steel industries, a price shock acts as a terminal blow to competitiveness. We have seen this in the European heartland, where historic industrial giants were forced to curtail production or relocate to the United States and Asia to find cheaper energy. This is economic displacement. When a factory in Bavaria shuts down because the cost of gas has increased fivefold, the loss isn't just a number on a balance sheet. It is a permanent loss of high-skilled jobs and technological IP. This shift affects the national current account, as the country transitions from an exporter of high-value goods to a desperate importer of basic energy. The blackmailer's goal is to hollow out the industrial base of their rival, rendering them economically irrelevant on the global stage. This process creates a hollowing out of the middle class, as the industrial backbone that supported generations of families is snapped by the sheer weight of energy costs. In this context, the energy valve becomes a tool for long-term economic restructuring, where the winner is not the one with the most innovative ideas, but the one who can keep the furnaces burning at the lowest cost. As the industrial base fractures, the focus shifts to energy arbitrage, the practice of buying energy from one source and selling it to another at a massive premium. During a period of energy blackmail, middleman nations often emerge, profiting from the desperation of the targeted states. We see this in the sudden rise of shadow fleets and the rerouting of pipelines through third-party countries. For the economist, this represents a massive inefficiency in the global market, leading to a rise in deadweight loss, where the total cost to society exceeds the benefit of the trade. The consumer ultimately pays for this inefficiency through agflation, or agricultural inflation. Because modern farming is essentially the conversion of natural gas into fertilizer and diesel into calories, the blackmailing of the energy sector is an indirect blackmailing of the global food supply. This is where the crisis turns from a financial one into a humanitarian one. In countries like Egypt or Lebanon, where food subsidies are a critical component of social stability, a spike in global energy prices can trigger bread riots and political revolution. The butterfly effect of energy manipulation means that a decision made in a boardroom in Moscow or Riyadh can lead to the collapse of a government in North Africa. The interconnectedness of our global trade system ensures that there is no such thing as a local energy shock. The vibrations travel through the price of wheat, the cost of ocean freight, and the stability of the global insurance markets. The crisis eventually reaches the sovereign bond market, the risk-free foundation of the global financial pyramid. When a nation is subjected to prolonged energy blackmail, its fiscal deficit widens as it attempts to subsidize energy costs for its citizens to prevent social unrest. This borrowing spree puts pressure on sovereign yields. As the supply of government bonds increases, their price falls and interest rates rise, leading to a tightening of financial conditions across the entire economy. Investors begin to look at the energy-to-debt ratio, a metric that measures how much a country's debt service depends on stable energy prices. If this ratio becomes unbalanced, we see a flight to quality, where capital exits the vulnerable nation's markets in favor of safe haven assets, like the US dollar or gold. This capital flight further devalues the local currency, making energy imports even more expensive and accelerating the downward spiral. This is the same mechanism that triggered the collapse of the Thai baht in 1997 and the Russian ruble in 1998. The energy blackmailer understands that they don't need to defeat a country on the battlefield if they can trigger a bond vigilante strike that spikes the nation's borrowing costs to unsustainable levels. In the 21st century, the most devastating siege is not a blockade of ships, but a blockade of affordable BTUs that forces a nation to bankrupt itself just to keep the lights on. The ultimate pressure point in this economic siege is the liquidity trap. As energy costs drain the capital of both corporations and households, the velocity of money, the rate at which it circulates through the economy, slows to a crawl. People stop spending on anything but the bare essentials, leading to a paradox of thrift where collective saving actually accelerates the economic downturn. For the U.S. economy, which is 70% driven by consumer spending, this is a lethal scenario. We observe the impact in the commercial paper market, where companies issue short-term debt to fund their daily operations. When energy blackmail induces market fear, this market can freeze, leaving even healthy companies unable to meet payroll. This systemic risk is what keeps central bankers awake at night. They are forced to step in as the lender of last resort, expanding the balance sheet through quantitative easing to keep the financial gears turning. However, this injection of liquidity into an economy with restricted energy supply is like pouring gasoline on an inflationary fire. It creates a stagflationary loop, where the currency loses value while the economy fails to grow. The blackmailer watches this from the sidelines, knowing that every dollar the government prints to mitigate the crisis further dilutes the nation's long-term financial power and increases its future debt burden, effectively mortgaging the next generation's prosperity for today's survival. In the face of such systemic threats, the role of energy diplomacy undergoes a radical transformation. No longer is it merely about securing contracts. It becomes a form of high-stakes financial engineering. Governments begin to facilitate forward purchase agreements at the state level, using taxpayer-backed guarantees to secure future energy deliveries. This is an attempt to stabilize the real exchange rate, the price of domestic goods relative to foreign goods, which is often decimated by energy-driven inflation. However, these state-backed interventions can lead to a crowding out effect in the credit markets. When the government borrows heavily to secure energy reserves or subsidize utility bills, it leaves less capital available for private sector investment. This leads to a stagnation in total factor productivity, as businesses cannot afford to upgrade machinery or invest in R&D, while they are struggling just to cover their electricity overhead. The economy enters a state of suspended animation, where growth is sacrificed at the altar of stability. This is the subtle victory of the blackmailer. They don't have to destroy your economy. They only have to make it too expensive for you to innovate. By forcing a nation to divert its capital from the future to the present, They ensure a long-term decline in that nation's global competitiveness, shifting the center of economic gravity toward those who control the primary resources. To counter the leverage of energy blackmail, the modern state must pivot toward energy sovereignty, a strategy that transcends simple production. It involves the radical diversification of the energy mix to include nuclear, renewables, and advanced storage, effectively shortening the supply chain to eliminate the middleman's chokehold. From an economic perspective, this is a transition from a variable cost model, where you are at the mercy of daily market fluctuations, to a fixed cost model, where the primary expense is the initial infrastructure investment. This shift is reflected in the levelized cost of energy, LCOE, a metric that shows how renewable sources are increasingly undercutting hydrocarbons in long-term stability. However, the transition itself creates a new financial vulnerability, the green inflation, or greenflation. Building this new infrastructure requires massive amounts of copper, lithium, and rare earth minerals, the prices of which are also subject to geopolitical manipulation. The central bank must navigate this transition carefully. If they do not provide enough liquidity for green investment, the nation remains a hostage to oil. If they provide too much, they risk a speculative bubble in the commodities market. This is the strategic paradox of the 21st century. To escape the blackmail of the fossil fuel past, a nation must survive a period of intense capital expenditure that could, in the short term, make it even more financially fragile. The response of international financial institutions like the IMF and the World Bank often serves as the final line of defense, but their intervention comes with strings that can reshape a nation's social contract. When energy blackmail leads to a balance of payments crisis, these institutions step in with structural adjustment programs. These programs typically mandate the removal of energy subsidies, a move that, while fiscally responsible on a balance sheet, can be explosive in practice. For the individual, the removal of a subsidy means the cost of a commute or home heating can double overnight. This creates a political risk premium that discourages foreign direct investment, FDI. Investors aren't just looking at GDP growth. They are looking at the social Gini coefficient and the potential for civil unrest. If the cost of energy is too high, the risk of a sudden stop in capital flows increases. We see this in the spread of frontier market bonds, where the yield reflects the probability of a government being toppled by energy-induced riots. The central bank is then forced into financial repression, keeping interest rates below inflation to erode the real value of the debt, which effectively taxes the savers to pay for the energy crisis. This is how energy blackmail translates into a wealth transfer from the middle class to the state and, ultimately, to the foreign energy provider. As the crisis matures, the concept of energy resilience becomes the primary metric for credit rating agencies like Moody's and S&P. A nation's creditworthiness is no longer judged solely on its tax base or manufacturing output, but on its energy elasticity, how well its economy can absorb a price shock without collapsing. This leads to the rise of energy-linked bonds, where the interest rate paid to investors is tied to the price of oil or gas. For the government, this is a way to hedge its fiscal risk. If energy prices skyrocket, their debt service costs decrease, providing a natural buffer. However, for the individual investor, this introduces a new layer of complexity into retirement planning. Your 401k or pension fund is now directly exposed to the outcome of a pipeline negotiation or a maritime dispute in the Strait of Hormuz. We see a shift in asset allocation, where real assets, commodities, land, and energy infrastructure outperform traditional paper assets like stocks and bonds. This is the financialization of energy, where every electron and every barrel is transformed into a speculative instrument. For the average person, this means that even if you don't drive a car or own a home, your financial future is inextricably linked to the global energy market. The blackmailer's reach extends into your savings account, your insurance premiums, and the very value of the currency in your wallet, making energy literacy a vital survival skill in the 21st century. For the individual caught in the crosshairs of energy blackmail, the primary objective shifts from wealth accumulation to liquidity preservation. In an environment where energy-driven inflation erodes purchasing power, holding large amounts of cash in a standard savings account is a losing strategy. We observe a tactical shift toward inflation-protected assets, such as Treasury inflation-protected securities, TIPES, or commodities-based ETFs. Historically, during periods of extreme energy coercion, physical assets with intrinsic utility, what economists call productive capital, become the ultimate hedge. This might include owning a home with independent energy production or investing in companies that possess pricing power, those capable of passing energy costs directly to the consumer without losing market share. On a micro level, energy auditing becomes a household financial necessity rather than a hobby, reducing the energy intensity of one's life. Through thermal insulation, high-efficiency appliances, or transitioning to electric mobility, is effectively a way of lowering one's personal exchange rate risk against the hydrocarbon-backed dollar. By reducing the number of units of energy required to maintain a standard of living, the individual creates a personal strategic reserve, making them less susceptible to the price shocks that the blackmailer uses to induce social and financial panic. The psychological shift in individual survival strategies also leads to a resurgence in localism and the circular economy. When the cost of long-distance logistics becomes a tool for geopolitical leverage, the globalized model of just-in-time delivery faces a crisis of confidence. Individuals and small communities begin to favor locally sourced goods, not just for environmental reasons, but as a hedge against the volatile freight component of global prices. Economically, this is a move toward reducing externalities. By shortening the distance between production and consumption, the individual insulates their grocery bill from the fuel surcharges that plague international shipping lanes. We see a rise in energy cooperatives, where neighborhoods pool capital to invest in localized microgrids. This is a form of economic balkanization, where the monolithic national grid is supplemented by fragmented, self-sustaining cells. While this may reduce the overall efficiency of the national economy, it increases robustness, the ability to withstand a targeted strike on the energy supply. For the viewer, the lesson is clear. In an era of energy blackmail, the most valuable asset you can own is a reduced dependence on the very systems being weaponized. Decentralization is not just a technological choice. It is a financial defensive posture that prevents your personal stability from being used as a bargaining chip in a foreign capital. The endgame of energy blackmail is a profound reordering of the global hierarchy, where resource realism replaces the idealism of the post-Cold War era. We are entering an age where the strength of a nation's balance sheet is inextricably linked to its energy surplus. The traditional metrics of success, GDP growth and stock market indices, are being overshadowed by the energy return on investment, EROI. For the U.S. and its allies, the response to this leverage is a forced march toward a post-carbon macroeconomics. This transition is not merely an environmental mandate, but a desperate financial necessity to de-risk the global economy from the volatility of petrostate politics. As we have seen, from the 1997 IMF crisis to the modern-day collapse of the lira or the bolivar, the pattern is consistent. Those who do not control their energy destiny will eventually see their wealth liquidated by those who do. The energy to GDP intensity is now the most critical indicator of a country's future prosperity. If a nation can decouple its growth from the consumption of imported hydrocarbons, it effectively renders the blackmailer's weapon obsolete. This is the ultimate short squeeze on geopolitical coercion, a global pivot that turns the once mighty oil valves into stranded assets, shifting power from those who own the holes in the ground to those who own the technology of the future. As we look toward the horizon, the era of energy blackmail serves as a stark reminder that economic freedom is not a static condition, but a constant struggle for resource autonomy. We have traced the path of this hidden warfare from the volatile trading floors of New York to the darkened factories of Europe and the struggling households of the global South. We have seen how interest rates, currency pegs, and sovereign debt are all merely layers of a financial architecture built upon the steady flow of oil and gas. The ultimate insight for the viewer is that energy is the master resource. It is the common denominator of all economic activity. To ignore the geopolitical leverage of hydrocarbons is to ignore the primary driver of 21st century inflation and inequality. However, the very attempt to weaponize these resources is accelerating a global shift that may eventually render such blackmail impossible. The transition to a diversified, decentralized, and technologically driven energy landscape is the greatest de-risking event in human history. It is a transition from a world of finite, contested molecules to a world of infinite, harvested electrons. Until that transition is complete, the individual must remain vigilant, understanding that their financial security is tied to a global grid that is increasingly being used as a battlefield. By embracing energy efficiency, financial hedging, and technological independence, we can finally strip the kill switch from the hands of the dictators and ensure that our economic destiny remains our own. How does this story resonate with you? I'd like to hear your perspective, so feel free to share your thoughts in the comments. If you found this video useful, consider subscribing and giving it a like. Thank you for watching, and I'll see you in the next video.